Hello and welcome to IIEA Insights with me, Dan O'Brien. In the last episode, we discussed the radically changed economic policy path the US has taken under the Trump presidency, mostly from a European perspective. Such is the scale and import of the change that we are returning to the same subject, but with an American contributor today. It's a pleasure to welcome Brad Setzer back to the Institute. He's a Senior Fellow at the Council of Foreign Relations. Previously, he's worked at the United States Trade Representative as Deputy Assistant Secretary for International Economic Analysis at US Treasury and as Director for International Economics on the staff of the National Security Council, among others. He regularly blogs at his Follow the Money blog and posts most days to his 125,000 followers on X. Brad, you're very welcome. Thanks for giving us your time today.
My pleasure. Thanks for inviting me here.
But look, we're very much focused on the sort of international economic policy implications. But let's start with the US itself. At this point, how do you assess the economic and market impact that tariff policy and other policy changes have had on the US economy itself and US financial markets and how the two interact and feed off each other?
Well, look, it's turned out to be quite a shock one expects to the US economy. It's certainly been a shock to the financial markets. The so-called reciprocal tariffs, which were in no way reciprocal. They were calculated on the basis of the bilateral goods imbalance, so they're a little bit misnamed. But they surprised enormously to the upside, and they triggered a shock to U.S. equity markets, a shock to confidence. All the soft indicators about the U.S. economy have turned down. And then sort of surprisingly, they also prompted a bond market sell-off and a bit of a sell-off in the dollar. So they seem to have triggered a broad re-rating and reevaluation of what I would call the American exceptionalism trade. The notion that the U.S. uniquely offered superior equity market and bond market returns. So investors around the world should be overweight U.S. bonds and overweight U.S. equities. My expectation now, given the shock to confidence and given the scale of the tariffs, I mean, they go up and down on certain products on any given day. They aren't done yet. We're still rolling out tariffs on pharmaceuticals, on semiconductors, and the tariffs on China have reached levels which are almost nonsensical to flow into a standard economic model. Some tariffs are, like the median tariff is sort of around over 145%, and a standard model says any tariff above 50% is prohibitive on bilateral trade. So should you really take the full costs of the tariff, or should you just say at this level there'll be almost no trade? But when you throw that all in, you get a shock, which at least I think would be enough to trigger a shallow recession. The depth of that recession depends on the policy offsets. And also depends, and by that I mean what happens to fiscal policy. Right now it's a fiscal consolidation. And then also what happens to with all the bilateral negotiations, which at least in theory offer a path to some form of de-escalation.
And you see that de-escalation with China as well as other countries?
Look, right now, there doesn't seem to be any active negotiations with China. President Trump is asking President Xi to start those negotiations. So far, the adjustments to the tariffs have been unilateral ones by the U.S. to try to mitigate the damage from 145% tariffs on certain specific sectors, notably on electronics, notably on my favorite quote unquote Irish, I mean a little ironic, technology company called Apple, which was going to be devastated by the 145% tariff. And that tariff was reduced to 20%. Now, why Apple got hit by the fentanyl tariff and not anything else is a historical question. But that at least made the tariff a little bit more manageable for Apple and firms importing laptops. But right now, there's no negotiation with China. The whispers coming out of the White House are that they hope deals with Japan, deals with South Korea will bring China to the table. I think the Chinese are hoping that the pain of this, truly extraordinary level of tariffs will force the administration to the table, given that the disruption may be larger on the U.S. side than on the Chinese side.
I suppose we're all speculating as to what the ultimate objective of these tariffs is, and many people say that maybe even Trump himself doesn't know. But do you have any insight into where this policy, what the ideal outcome of this policy is? Is it almost completely changing the import penetration for the U.S. economy and becoming much more reindustrialized and self-sufficient? Or is it an attempt to cut deals and radically reduce remaining barriers to goods trade in the world? Do you have thoughts on what the ultimate objective is?
Look, I think President Trump has been consistent on one thing. And that one thing is that he thinks tariffs are a multi-purpose tool. They're his Swiss Army knife. And so therefore he intends to use them to pursue a wide range of objectives, including foreign policy objectives. He has often suggested that financial sanctions damage the global role of the dollar, and he would prefer to use tariffs to say, penalize countries for importing Iranian oil. Now, he's got a problem now because his tariffs on China are already prohibitive, and he can't, at some point, China won't care. I think on one level, it is reasonably clear that the president is looking to get some revenue out of his tariffs. So I think you can reasonably hypothesize until we get a deal to the opposite that he wants the 10% baseline tariff, which applies to everyone outside of North America. That as of now, that looks like it's a permanent feature. It's not something he's going to negotiate away. It's a revenue raiser. It should generate somewhere between a half point and 73/4 of a point of GDP and revenue, more upfront, less over time. The other tariffs are, at least in principle, some mix of fully protective in specific sectors like steel and aluminum, perhaps autos. We can debate pharma. I'm sure we will debate pharma. The goal seems to be to reshore those industries, to force firms to produce in the U.S. if they want to sell to the U.S. market. And then the remaining tariffs are, at least in theory, open for negotiation. So they would be available if there was a deal that wanted to liberalize other countries' markets, so hopefully grow U.S. exports. Now, there's a little asterisk there. If all the other country gets out of the deal is relief on the reciprocal tariffs and not relief on the baseline tariff, the 10%, and on the sectoral tariffs, how much liberalization will other countries offer? But in the second element of the Trump goals is not necessarily open trade. It is a bilaterally balanced trade. And in some cases, though, the deals may look much more like managed trade than open trade, with strong purchase commitments or other commitments that provide benefits in Trump's view to the U.S. economy, but are much more of the kind that were part of the China Phase One deal. So I think the difficulty the rest of the world faces is that one tool is being used for multiple objectives, and at least 2/3 of them fall outside the realm of traditional trade policy.
In terms of China and the rest of the world, is there a difference between China? Is there a genuine, as you say, tariffs are used for not just economic policy means, but also foreign policy means? Do you think that the administration genuinely wants to radically decouple the two economies, and China will be treated differently and will have permanently higher tariff levels than the rest of the world? Or do you think there's a possibility that the administration will cut a deal and treat China similarly to everyone else?
I think there's a little bit of a debate inside the administration. I think there are people who believe that China should be treated fundamentally different. And I would note that going into this round of tariffs, China was treated significantly differently. The Section 301 case, the first Trump trade war, was just against China, and it did raise tariffs on China by about 15 percentage points, while tariffs on everyone else pretty much remained unchanged. So China already has been treated differently. The question is how much differently, and I think some people would be quite comfortable with essentially prohibitive tariffs, which would decouple. If it's 50%, it will decouple over time. There'll be some people who will pay. If it's 150%, it will decouple immediately because almost no one can afford to pay that. Businesses will just go under rather than pay. And then I think there's at least speculation that the president himself is open to some form of deal. Maybe that involves China allowing TikTok to be sold. Maybe that includes a lot of renewed purchases. But that kind of deal would nonetheless leave China with higher tariffs than the global norm. That would at least be my expectation about the ultimate endgame. But I would note that right now we're in a world with, let's say, ignoring the sectoral tariffs, 10% on the world, 145% plus the original Section 301 tariffs on China, so 145% up on China. So we are, unless something changes, we're on a path towards decoupling.
That you mentioned sort of permanency with 10%. Impossible to say. Obviously, U.S. politics very uncertain now, and the Democrats, what happens in the midterms and further down the line, impossible to say. But do you have any sense as to whether a tariff policy like this would outlast the current administration? Certainly during the Biden administration, there wasn't much change from the more protectionist policies of the first Trump administration. Is the U.S. going to look in on itself more and be less open to international trade for the foreseeable future, if that can be judged or assessed at all at this juncture?
Well, I may be a tad defensive on this point because I was in the Biden administration in the first 18 months. But I think it's actually an incorrect perception that the Biden administration discontinued the Trump trade policy. The Biden administration maintained the Trump trade policy towards China and in some ways toughened it up. It was certainly tougher on some technological competition components, and it did strengthen the tariffs around clean and green energy products, where the U.S. had an industrial policy, which Trump doesn't believe in. On the other hand, I think people forget just how many potential trade wars the first Trump administration had lined up with Europe. We were heading towards a trade war over the steel and aluminum tariffs. We were heading towards a trade war over Boeing and Airbus. And we were headed towards a trade war over the digital services tax. In all three cases, deals were made between the Biden administration and the commission, which, while not complete settlements, so there's all these cases can easily be revived. The steel case has been revived. They were de-escalation steps that avoided the introduction of tariffs. So I think there was a meaningful difference. The Biden administration genuinely tried to de-escalate with allies. I know a lot of people in Europe were upset about the Buy America provisions in the Inflation Reduction Act. But if you look at their economic impact, they were minimal. In some cases, exceptions were made within the context of the law, the so-called leasing exception for electric vehicles. Sounds technical, but German exports went way up after the Inflation Reduction Act, not down. And in general, the subsidies provided to clean and green energy investment in the U.S. led to a boom in European exports of clean and green technology to the United States. So I don't think it's one of pure continuity. And you can argue that offers a bit of hope. Because it suggests that when the tariffs lack broad support, they can be rolled out. The conventional wisdom in trade policies is easier to put tariffs on than to take them off. But in this case, I think President Trump's tariffs have gone well beyond the political consensus in the United States. And in those areas where the Trump administration has gone well beyond the political consensus, yes, I do think they can be rolled back. If they become embedded in the revenues of the U.S. government, it becomes a little bit more difficult. If you have to come up with a pay for to get rid of the 10% tariff, raise some other tax, yes, that makes it a little harder. But some of the other Other trade actions, at least in my mind, don't have the kind of bipartisan support which would suggest that they would outlast an administration if there's a change in party.
Okay, and certainly very fair points about pulling back from confrontation with Europe under the Biden administration. Just while you're on, and given your sort of involvement in the Biden administration, there was a lot of optimism. In fact, I think the last time you joined us, we spoke about whether or not industrial policy could be successful. That was about 2 years ago. Do you have any take now on whether or not the Biden industrial policy measures could be viewed as a success, mixed, didn't work?
I would say the balance sheet, bilan en français, is mixed. Unambiguously, the CHIPS Act, the industrial policy around semiconductors, was working. You can see that in the investment numbers in electronics manufacturing, which has shot up. There are 10 new semiconductor fabs being built in the United States, and there were basically none being built before the CHIPS Act. So the CHIPS Act to me was a clear success. It was quite generous towards semiconductor manufacturers, both American manufacturers like Micron and Intel, but also to TSMC and Samsung. And when combined with concerns from Apple and NVIDIA about their over-reliance on Taiwan and the fact that a geopolitical confrontation over Taiwan would essentially destroy their businesses, and two of the five most valuable U.S. companies would be unable to deliver product if there were an escalation around Taiwan. So they realized the vulnerability. We did get something significant done there. I'm worried that the Trump administration doesn't view that as a success, or at least believes that tariffs can replicate what the investment incentives achieved. I think the Inflation Reduction Act's efforts to encourage investment in green and clean technology had a more mixed impact. You do see investments in solar in the US. Investment in wind was helped by the Inflation Reduction Act, but hurt by higher interest rates, as in Europe. So you haven't seen it take off. And the US still lags in EV adoption. And obviously, that it would take time. I think there's elements in the Inflation Reduction Act that could and should have been built on, but I would call that a mixed success. On things like active pharmaceutical ingredients that come from China, and on permanent magnets, which use rare earths that also now almost all come from China. The Biden administration talked a big game, but it didn't deliver near enough. So on that part, I would give it a failing grade.
Okay, that's fair. I didn't mean to go back to history, although it's very interesting, given how much is going on right now. Maybe let's veer back towards more immediate matters. A lot of talk about the US Treasury market. You mentioned it earlier on. How much, I would note that the yield on the 10-year was almost 5% in January, considerably higher than it spiked up to last week. So I wonder to what extent did turmoil in the US government bond market triggered the postponement of tariffs last week? Do you think that's been overplayed, or do you think that really was the key factor last week?
I think it was certainly one key factor. I would also put some weight on the equity market sell-off. I mean, obviously, Scott Bessent, the Treasury Secretary, focuses very heavily on the bond market. I think it's not just the absolute yield, because you're right, it was higher at other times. It was higher earlier in the year. It was the fact that the bond market was selling off, even as expectations around U.S. growth were coming down, and even as in many cases, expectations for a recession were building. Now, a recession that is induced by a rise in tariffs, a consumption tax that in the short run pushes the price level up, poses some challenges to the Fed and therefore to the bond market. It isn't clear that the Fed can immediately cut when prices are well above its target, and when there's, to use Chairman Powell's phrase, an inward shift in the supply curve. So we're a little bit less productive as an economy as a result of the tariffs. That said, in general, you don't want the bond market selling off as the equity market sells off and as expectations of growth are coming down. And so the fact that the bond market sold off, I think, matters a little bit more than the fact that we still don't have a 5% handle on the 10-year. The issue is that everything else suggested the bond market should rally, and the bond market was selling off.
And in terms of the dollar, again, another times of uncertainty, dollar tends to appreciate. The general expectation was the tariff announcements would lead to dollar appreciation. Instead, there's been quite a big fall in the dollar. And questions raised is, again, you mentioned at the beginning about the reserve currency status of the dollar. I mentioned to you in the list of questions beforehand that I have a book on my shelf by Barry Eichengreen that's about 15 years old, and it's subtitled "The Rise and Fall of the Dollar." There's been a lot of talk about changing reserve currencies over the years. Do you think that's possible? And what's the alternative reserve currency?
Well, I think there are actually two separate questions. One is around a change in the reserve currency. And in order to talk about that, you have to define what constitutes a reserve currency. I think a lot of people mean more than just the currency used to denominate the majority of the world's foreign exchange reserves, the narrow meaning of the reserve currency. Some people also mean the currency used to settle a lot of global trade and a lot of global financial contracts. In some sense, that's the dollar's global role, which goes beyond just being the currency of official reserves. I think the dollar's recent weakness actually has absolutely nothing to do with changes in the dollar's status as a global reserve currency. I think it's completely a separate issue. I also don't think it's actually true that the dollar always rallies in times of stress. I think the dollar rallied in the global financial crisis because it was a funding currency, not because it was a safe haven. And I can go into all the details for why I think that. But the yen also rallied, and the yen was also a funding currency at the time. I think the dollar is selling off now, not because of some deep fundamental shifts in the global architecture, but rather because the dollar was the destination currency in a lot of carry trades. A carry trade is when you borrow or reduce your holdings in the low yielding currency and put your money in the high yielding currency. And when you have risk off moves, high yielding currencies generally sell off. Destination currencies generally sell off. So I view the dollar's down move as a carry unwind, if you want to think of it that way, as a reduction in the American exceptionalism trade, the notion that you cannot be too overweight U.S. equities, you can't have too many U.S. corporate bonds, you can't be too overweight the dollar, because the dollar goes up, U.S. bonds yield more, and U.S. equities only go up. I think there's been a reevaluation of that when a country basically throws itself into a recession, as I expect, because of in a sense, ideological views of the president. That is a challenge to the exceptionalism trade. There is a second question, which is over time, can a country that wants to turn inward, that wants to trade less, that wants to reindustrialize through import substitution, can its currency still play this large role, outsized role in the global economy? I think that's an open question. It is hard to change. Network effects are very powerful. People have been talking about alternatives to the dollar for a long time. China has been talking about the RMB as an alternative to the dollar for a long time. But in the end, in my view, there's actually only one true alternative to the dollar. I don't actually think we only have one reserve currency. I think we have two. I think the euro, for most purposes, works relatively well as a currency to denominate global trade, as a currency to settle global financial contracts, and as a currency to denominate foreign currency reserves. I personally think the dollar's higher share, particularly in reserve holdings, is mostly a reflection of the fact that the dollar's yielded more than the euro. The zero interest rate policy, the absence of high yielding, safe European government bonds, because Germany wasn't issuing any a couple of years ago, that was the main constraint, in my view, on a bigger global role for the euro. So I do expect over time the euro to play a bigger role because I think the euro and the euro area and the EU, not completely congruous, but heavily congruous, have just a fundamentally different view of trade than President Trump and much of the United States.
Leads me to a question on FDI and trade. So, if these tariffs prove permanent, and the U.S. insists that more production, both the production for the U.S. market, is done in the U.S., and also that pressures U.S. companies to, instead of producing for, say, the European market via its subsidiaries in Europe, pressures them to come back to the U.S. And trade that way. Do you see how do you see both of those two factors playing out? Particularly the first one, I imagine it's going to be pretty difficult for any administration to demand that subsidiaries servicing the European market would move back to the United States. But in terms of bringing bringing U.S. companies that are based in Europe back to the U.S., particularly in the pharma sector, which we'll get into in more detail. How possible do you think that is? How achievable is that?
Well, maybe I'll talk about autos before I talk about pharma, because I think in autos there's a reasonably clear path forward, which does involve more foreign investment in the U.S., largely by foreign-owned companies that already have a U.S. presence. If the U.S. auto market in a typical year is around 16 million cars, right now, across all the manufacturers, not just the U.S.-owned ones, only about 8 million of those are made in the United States. Now, the U.S. makes a couple million of cars to sell globally, mostly in North America, so U.S. production is a little higher. But only about half of the cars sold in the United States are made in the U.S. By any counting Toyotas and BMWs that are made in the U.S. Now, in large part, that is because somewhere between 3 and 4 million of the U.S. market is met by cars where the final assembly is in Mexico or Canada. And one of the things Trump has done, and it's a clear breach of the first Trump trade agreement, the USMCA, but he's put tariffs on imports of assembled finished cars from Canada and Mexico, even if they're coming from GM and even if they're coming from Ford. So if those tariffs persist, there will be a reallocation of some of that production back to the U.S. In addition, BMW and Mercedes, which now produce SUVs in the U.S., but they're sedans, luxury sedans, which are sold in the U.S., are mostly produced in Europe. A lot of the engines that go into the SUVs are produced in Europe. I think if the 25% tariff persists, BMW and Mercedes face a choice. Either they can retreat to the very top end of the luxury segment and service that from Europe, because they'll have to pay the 25% price penalty, or they can reallocate and produce more of their sedans in the U.S. So I think the tariffs narrowly will generate more U.S. auto production. It will also increase costs, and the size of the U.S. market will shrink. And the exports that the U.S. now has will wither. I mean, if we don't let Canadian cars into our market without tariffs, Canada is not going to let our cars into their market without tariffs. But it is a vision of America alone in the autos. It's in the U.S. for the U.S., and the U.S. is a big enough auto market and a profitable enough auto market that it will get some foreign investment. I think the irony in the pharmaceutical sector is that European companies, Novo Nordisk, for example, have actually been relatively willing to produce in the United States. Novo Nordisk makes Wegovy in the United States. They can do so because it doesn't impact their tax position. The irony is that an awful lot of the imports into the U.S. in the pharmaceutical sector, which are gigantic, are coming from U.S. companies producing offshore. And producing offshore so as to avoid the headline 21% U.S. corporate tax rate. Think about a 25% tariff on a product like pharmaceuticals, which has an exceptionally high margin, low production costs, where the transfer price, the price the company charges itself, it's a U.S. sales company contracting with its Irish production company for a drug where the rights are technically owned by its intellectual property company, which is in Europe somewhere, but that intellectual property company is ultimately owned by the U.S. parent. It's all within the company. The high transfer pricing is to get the profit out of the United States, and that's what impacts the trade data. So I think in those sectors, a 25% tariff, if it can't be passed on, if Medicare and Medicaid aren't going to pay more, if the big insurers aren't going to pay more, sort of becomes like an income tax. And thereby it will have some impact on over time on the location of production. But I think in the more immediate sense, on the location of intellectual property and the transfer prices.
So you'd see the transfer pricing changing in a way that would reduce the trade flows between, say, Ireland and the US.
It would reduce the dollar value of those trade flows, the actual molecules, the biologically active ingredients would not change. But yes, reduce the dollar value assigned to that.
Okay, so
Just basically find ways to allocate more of the profit to your US headquarters, which would have the effect of reducing the price your US sales corporation pays the Irish production corporation for that molecule or that biologically active ingredient.
so does that mean, in your assessment, that existing production patterns would remain in quantitative terms? But what would that mean for longer term investment? In other words, would those pharmaceutical companies see a value in continuing to invest in production capacity in Ireland, or does the tariff and the change in transfer pricing mean that they're going to effectively, over time, because they've sunk costs in capacity here in Ireland, that they would over time invest in US capacity and run down the actual quantity of stuff they're producing here?
I mean, I think that would be something that would be determined by the market. My expectation is that there would be a bit less investment in new production in Ireland, but it wouldn't go to zero. And my expectation is that Ireland has some advantages that are separable from tax, that there's a built up skill set, workforce, knowledge base. There are real advantages to Irish production. And certainly the advantages for producing in Ireland, if you're a US company for sales into Europe, would largely remain. But to the extent that some of the production advantage was tied to tax avoidance, if you take away the tax avoidance, you would, in my view, lead to some reduction in production over time. But I don't think it's a 0-1. I think it's sort of Ireland got maybe too heavy, too big in the global production side, thanks to this nexus between tax avoidance and skill, and that if Ireland is just competing on skill and workforce and the like, there'll be less production, but not no production, less new investment, not none.
And just leaving aside the tariff thing, if US corporation tax were to come down to Irish levels, how would you imagine the impact on production patterns?
Look, my sense is if the U.S. Headline corporate income tax comes down to 15, for most U.S. pharmaceutical companies, the advantages of being having a simplified tax structure where the intellectual property is retained in the U.S. and the existing Irish facilities become contract manufacturers rather than profit centers, rather than mechanisms for shifting profit offshore. I think that you would see that reallocation, particularly if there's a reinstatement of the R&D tax credit, so U.S. companies can bring their headline rates in the U.S. below 15. I'm not at all sure you're going to get the headline rate down to 15.
Yeah.
That would be a big revenue loss because there's a lot of U.S. companies like Walmart that can't profit shift that would be hit. But there is some possibility that that happens. And if that happens, I think speaking as an American who cares a little bit about the tax base of the United States, you would certainly put in additional provisions to try to make it harder to have the profits on U.S. sales from U.S. companies with intellectual property developed in the U.S. all be registered in Ireland or Malta or Hungary or Belgium or other locations. You would want that profit to be in the U.S. And because, it's sort of shocking, but in 2023 and 2024, the top 6 U.S. pharmaceutical companies literally reported that they set aside zero collectively. One paid a little bit, others had negative, but collectively set aside zero to cover their 2023 U.S. corporate income tax liability and set aside zero to cover their 2024 U.S. corporate income tax liability. So all the profit and all of the corporate income tax on U.S. pharmaceutical companies is now being collected in various European jurisdictions in Singapore. You know, you could see how some of that should accrue to your production subsidiary, and some of the profits are attributable to sales in Europe. But because of US pricing, the bulk of the profit is actually attributable to the US. And so I would think the US would want to make sure that that profit is attributed to the US. It's a little bit of a pay for the overall reduction in the corporate income tax. So, I mean, I do think there's a risk to Ireland there, certainly a risk to Ireland's tax base. But as I mentioned, if you in the short run, the production subsidiaries can become contract manufacturers in effect for their parent. They won't cease to operate.
Okay, well, audience members and those who listen back to this on a podcast will be able to find Brad at the Council on Foreign Relations. Thanks to everybody who tuned in. I hope you found it as useful as I did, Brad. Fascinating insights and discussion there. Many thanks for giving us your time. We look forward to welcoming you back in 2 years or maybe even less. Thank you.
Thank you. Bye.